Welcome back to Seed Safe Financial. Wait, what am I talking about again? Today, we're diving into demystifying IRAs and fancy strategies called backdoor Roth contribution. Let's start with IRAs, individual retirement accounts. IRAs are tax-advantaged accounts designed to help individuals save for retirement. There are two main types of IRAs, traditional IRAs and Roth IRAs. In a traditional IRA, your contributions may be tax deductible, and your investments grow tax deferred until you withdraw the money in retirement. At that point, withdrawals are taxed as ordinary income, like salaries. However, if you are over the IRS income limit, then your IRA contribution may be considered non-deductible. In that case, your contribution is considered made with after-tax dollars or cash out of your pocket, which means it also maintains a basis that is reported on your tax return. Roth IRAs are also subject to an income limit and are funded with after-tax dollars, meaning you don't get an immediate tax deduction for your contributions. But the big perk here is that qualified withdrawals, including both your contributions and the earnings in the account, are tax-free in retirement. Since it comes out tax-free, the government likes to limit your contribution there. The maximum IRA and Roth IRA contribution for 2024 is $7,000. If you are age 50 or older, you can add an extra $1,000 catch-up. Now let's talk about backdoor Roth contributions. This strategy is primarily used by high-income earners who may not be eligible to contribute directly to a Roth IRA due to the income limits set. So what are these income limits that you're speaking of, Rebecca? Well, the IRS says we're giving you a benefit, and so it's going to be limited. With that limitation, a lot of times what they're looking at is either limiting a contribution level, so that's the $7,000 maximum contribution we spoke about for 2024. And on the other side, they might also say, you make a little bit too much money, we're not going to allow you to get that benefit unless your income is below certain thresholds. Well, these income limits are basically thresholds that change a little bit from year to year as inflation rises or gets a little bit lower. Thanks tax policy for changing all the time. And in this case, it's going to be $161,000 for a single taxpayer, whereas for married joint filing individuals, then that is going to be $240,000 as a threshold. And so when we're looking at IRA contributions, we have to understand, are we below? Are we above this limitation? But here's the catch. How do you even know what your income is until after year end? This is why a lot of times it doesn't come up until you've filled out your tax return. So the IRS recognizes that, and they say you can make a 2023 IRA or Roth IRA contribution by April 15th, 2024, when your tax return is originally due. So if you make $245,000 in total income, you will not be able to make a Roth IRA contribution or a deductible IRA contribution. This is why backdoor Roths have become so popular and interesting. So why is it called a backdoor Roth contribution? Well, we're really looking at utilizing both the IRA and the Roth IRA in a strategy that allows you to say, I'm above the income limits. Let's say I make $400,000. Since you're making too much money to contribute directly to a Roth IRA, you can't deduct this contribution from your taxes. Well, you can still utilize the backdoor strategy by making a non-deductible IRA contribution. Once that non-deductible IRA contribution is made, then it can be converted to a Roth IRA and continue to grow tax-free from there. Since you've already paid taxes on the contribution, you won't owe any additional taxes when you convert it. It is an amazing benefit, but sometimes we just don't talk enough about it. However, I bet your CPA has asked you if you've made an IRA contribution. They may just not have explained it a little bit more in detail. Warning, if you have rolled over a 401k to an IRA, then this strategy may not work as well for you. They take the ratio of pre-tax to after-tax funds to determine how much of the conversion is taxable income. This strategy works best when you can move any pre-tax IRA money back into your current 401k. And why is that? 401ks are regulated by the Department of Labor, while IRAs are regulated by the U.S. Treasury. So it's a little bit different between how those two are treated. It's also different in the case that 401k contributions and 401k plans, being regulated by ERISA, have a little bit of a different size amount that you can put towards it. So how is a mega backdoor Roth contribution different than a backdoor Roth? A mega backdoor Roth contribution utilizes a 401k plan to put away more towards the strategy than you could with an IRA, thus the mega. To a 401k, you can do $23,000 in contributions from an employee standpoint, whereas with an IRA, it's only $7,000. The other differences are really in the components of the strategy. So instead of making a non-deductible IRA contribution, you could look at whether your 401k allows you to make after-tax contributions. The after-tax 401k contribution is different than your employee 401k or your Roth 401k employee contribution. The after-tax 401k maximum is regulated by all contributions to the 401k. The maximum employee and employer contributions allowed in 2024 is $69,000. And so you can look at making your usual employee contribution of $23,000. Your company can match that contribution, maybe 3 to 6%, and then that might mean you have $40,000 extra dollars you could put towards an after-tax 401k. Then the conversion piece is from your after-tax 401k to a Roth as an in-service conversion. Not all companies offer an after-tax 401k, but we find this is a hot topic among the biggest tech companies. It's absolutely incredible because this takes the backdoor Roth strategy and turns it into a mega backdoor Roth strategy. This has been all the rage at large tech companies lately because of the fact that this really magnifies every year how much you can put aside. And if you're a high income earner and you're looking for ways to tax optimize for now, the future, and in retirement, then this is going to be a strategy that you'll be able to implement annually. It's like, God, Congress, loopholes, come on. Remember, never commit more than you can afford to from cash flow. It is not worth racking up credit card debt in order to be tax optimized. Don't let the tax tail wag the dog on this one. But if you can, it is a strategy you will remember and can utilize every year. Whew, that was quite a discussion. Thank you for bearing with me through all of that. I know it's a lot, and I would love to hear your comments and questions, and we'll be able to dive in even further in the future. Hit that subscribe button so we can see you soon. Now go forth and grow your wealth.